Welcome, Mindful Multifamily listeners. I'm your host, Chris Salerno. Very excited to have you back on another episode of the Mindful Multifamily Show. I have a friend on here. His name's Nick. He's going to give us a wealth of knowledge and some very cool things he's doing here recently with a new fund that they've opened up. So excited to dive deeper into it. So sit tight and get ready. Nick, thanks so much for joining us.
Chris, really excited to be here, man. Excited to chat with you today.
Likewise. Well, let's break the ice. Tell the listeners and viewers a little bit about yourself and your background.
Sure. So Nic DeAngelo here. I'm with Saint Investment Group. We founded Saint in 2015, but really my background, I've been doing real estate for almost 20 years. And I'm classically trained with a couple small family offices where I was thrown into the fire of acquisitions in the wake of 2008. So very, very comfortable with the distressed asset space, very comfortable with complex acquisitions and different modeling for that side. And I've had the ability to stand on the shoulder of giants that I was trained really high level asset management techniques. So fast forward to today, our investors have gotten a little bit older and looked for different products. We've leaned very heavily into fixed income. So we can consider ourselves experts in the fixed income space. And also invest, as partners on multifamily deals with a huge also focus on industrial and, some other asset classes along the way.
Love that. Love that. What opened your eyes, as a company up to that fixed side when it comes to that type of fund?
Yeah. So, like I said, my background's acquisitions. I was able to beg, plead, and negotiate my way into work for free for a role that was way beyond me, right? I didn't make a dollar, but I was around really successful people. And what I learned during that period of time were when to take chances with really high opportunities and strategies to also build in fixed income that backstops and hedges against a downturn or big issues. So we've been buying mortgages for years, really me on the side, buying mortgages for years as part of packages with banks, especially in distressed markets. And what happened was we found that with our investor pool, many business owners, many are on the tail end of their careers or in retirement, huge, our average net worth is very high. It's in the, mid eights to high eight figures so high net worth guys that really were looking for something more consistent. They wanted something that would pay in or pay out every single month. They can get their money back flexibly. So we put the two and two together and just said, look, we understand the mortgage space. Despite our background being primarily syndicators, we understand the mortgage space very well and had a robust portfolio with over 500 loans that we attached to an income fund model and married that with what our investors were asking for. So, we still love the syndication model. I think with what's coming up in the market, it's a killer opportunity with discounts right now. But we also like pairing that with an income approach, which is what our personal investors, higher net worth, successful guys really were looking for right now. So we wanted to provide that for other syndicators to kind of help balance out portfolios.
Love that. And I think that's super important, especially given last year, where things are in the current market environment and with the multifamily space, a lot of individuals pause, stop distributions. Unfortunately, there's some negative things happened as well. So let's talk about the type of fixed income. Walk me through, what does that look like if I invested? What type of expectations can I have?
Yeah, absolutely. Fixed income is a sliding scale, right? So if you take something that's extremely, basically the more liquid something is, the lower the returns are. Yep. So what we're exploring right now, first off, we have an 8% fund. It pays out 8% returns with a 12% lockup period. Because we've been buying so many mortgages and partnering on so many deals and bringing in so many new assets, we're actually expanding our returns and bumping them up significantly. Where for a shorter term offering, maybe a 6-month lockup period, we can pay 6% all the way to if somebody's willing to go out, if they're looking for a 2-3 year hold, we're paying out a 12% return. So it's a pretty wide range for that period. And you're exactly right, Chris. It's a weird market right now. There's co-GPs on multiple deals, but I'm also an LP on a ton. I invest with quote unquote competition, but really I love the market. I love the space. If someone has a good deal, I want my money in it, right? But I'm seeing people not paying out also. So the fixed income product right now to balance out some of these huge opportunities that other people are invested in, that's where we saw as the biggest inroads. And if it's making a 12% competitive return at the same time, I mean, that's a good balance of both worlds.
Oh, most definitely, most definitely. And what type of opportunities are you investing that capital into?
Yeah, so we focus almost entirely for the fixed income fund, for the Saint Income Fund, on single family mortgages.
Got it.
Just because of the reason that it's such a ridiculously rock solid asset class. 98% of mortgages in the United States are fixed rate 30-year mortgages, right?
Unbelievable.
98%. It is ridiculous, right? It's the stability's unlike anything else in the world. So we like that as the safest asset class. We buy extremely conservatively. And really, it's just to give a hedge against everything else that, other investors might be looking at. And even us, we make a lot of longer term investments, 5 to 10 years on deals. So having something flexible and a rock solid asset class we see as really a good strategy.
Very much so. So let's talk about geographic. Are you guys focused all over the United States? Do you guys have one market that you guys are heavily, okay, we're going to own this market?
So with mortgages, it's a little bit different. If we were sniping out deals for, let's say, industrial, or kind of our bigger scale there, I'd tell you, Chris, there's only two markets I'm really interested in industrial. With mortgages, it's actually the exact opposite. You want to be in what you feel most comfortable and is most rock solid for your buy box. For us, we love suburban markets. We love middle-class markets. We're looking for the bread and butter, 3-bed, 2-bath, white picket fence, average home cost around $400,000. If you look nationally, pretty much in the middle. And we're looking for average incomes, middle-class families. So for us, that allows us to tap into a lot of markets. So state-wise, I think we're approaching over 30 states that we have mortgages in. Our mortgage count is over 500. So it gives us an opportunity to really spread the wealth around and spread the investment around. So if California has a bad day, no worries, because Idaho's doing great. And if Missouri's having a hard time, no worries, because Florida's strong. Those types of things where it really provides a lot of diverse and distributed assets around the country.
Very much so. What's that exit plan look like, for those type of opportunities that you're placing that capital into?
So there's really only two ways to make money with mortgages. We're purchasing on the secondary market. There's fix and flippers, just like we know fix and flippers. You buy something with a problem, you add value to it, and you flip it for the highest dollar you can. That is not us. That is not us. We do the second option. The second option for mortgages is you buy something, you maximize value, just like you do with any other real estate, and you cash flow it forever. That's us. So because the income fund's goal is to pay cash flow out, and we've never missed a distribution in over 10 years. So the income fund's goal is to never, ever miss a distribution ever, right? Like so many are doing right now. We are looking for things that are 20, 30 years of payments remaining, right? So if those are fixed and we can bet on those day in and day out, our current performance rate is 96.7% of on-time payments. Our goal is to not make the top dollar. Our goal is to make the consistent dollar every single month. So we're looking for long-term cash flow.
Love that. Love that. And so that long-term cash flow, when it comes to the returns for investors, is there any particular, exit that they're going to receive, or is it that ongoing high cash flow that they're going to receive?
So that's a great question, because people go, well, is it a pref plus a split on the back end? How are the numbers shaking out? We really are pressing returns in the mortgage space where we're offering very competitive rates just strictly on the distributions that we're sending out. So there is no split on the back end, because what most of our investors were looking for was more flexibility. And if we provided a split on the back end, it puts us in a position where we want to maximize returns rather than maximize stability. So instead of having a split on the back end, we have investors that can get out in 6 months, right? It's a 6-month fund. And after the initial window, they can get their money back in 90 days, anytime with notice. So it's like a rolling cash flow where they can get out when they want to. But because we have that flexibility, we can't build in an upside potential or a split on the back end, because it's the trade-off that we've made. And really, it's what our investors were asking for.
Yeah,
So
no, so it's definitely a high, Yeah, high income type of play currently, and then whenever you want your money out, you can take your money out within that, or you request a 90-day grace period, right? And then from there, you can place that capital wherever you want, but it's high current, which opportunities right now are not offering that. Depends on where you're at.
Bingo. And so that's what we wanted to give, is that flexibility you can't find in the market with a high cash flow.
Love that. Talk to us about the team that you have cultivated to make sure you are placing that equity into right positions and right deals.
I love it. So this question is so misunderstood. So Chris, I can tell, like, that's the high level question here, right?
I like to ask questions because I like to ask from, I'm going to invest, and I'm going to ask these questions if I was an investor into any of this opportunities that you present to me. So that's why it's just generic. I don't have a script or anywhere. It's just a nice casual conversation.
No, but that is the high level question, because there's multiple ways to skin this, right? It's anytime you're dealing with a team situation, you're always in business dealing with the team situation. Anytime you're dealing with a situation that requires high performance, the more high performance the team is going to be multiplied on the returns and multiplied on the output, right? We are in the investment space, right? So there's never been a higher risk reward ratio for the best people working on something. So I'd say we really leaned into that and said, anyone who's on our team at a high level has an opportunity to share the wealth of performance. So let me start there. That is because, you take guys like Steve Schwartzman of Blackstone, right? He says level 10 opportunities, or excuse me, level 10 talent always requires level 10 opportunities. Yep. Meaning if they operate at level 10, they need to be compensated and have the opportunities of level 10. So our team is the most ridiculous, seasoned, high-level investment team that I have seen in the space doing what we're doing. So on the asset management side, we have people that have been drilling down, that have worked with billions in assets over their careers. And when you're dealing with mortgages, it's a different skill set, especially in acquisitions. Because if you deal acquisitions with property, it's very relationship based, but people will kind of, it's also very price based. It's also very market based. It's also very driven by things like financing, right? You go into the mortgage space, it's in a completely different animal, because reputational risk for these large institutions is so high. Oh, so sure. if we're dealing with Wells Fargo, or if a group's dealing with Wells Fargo and Wells Fargo sells them a batch of loans and they foreclose on a bunch of elderly veterans, for instance, that goes back on Wells Fargo, not the person who actually owns those mortgages. So the high level mortgage trading and the high level mortgage buys and sells are between people that have the utmost trust and utmost respect for each other, which also, we're good players, we pay fair pricing, we work well, and our goal is to never foreclose. So we're really good buyers, and banks like dealing with us. Their reputational risk dealing with us is very low.
Love that. Love that. Walk me through any tax benefits that these type of properties offer.
Sure. So this is not a tax strategy. This is not. So when we get a call, just to give you an idea, we get a call from an investor and they say, hey, I'm on the way out of a business. I'm going to have this tax issue that I got to solve. We refer them to friends. We say, look, the income fund, if you need flexibility and high level cash flow, we're the best in class. No question, best in class. If you need a structured, very high strategic tax benefit, there are better options. So we will direct them to competitors that are, they're all friggin' friends, right? The space. Sure. It's co-opetition, right? So we'll pass them along gladly to somebody that's a really good opportunity for them on a tax side.
Love that. Love that. Talk to us about, what are you guys looking at? I know we chatted a little before the show went live. We talked a little bit about the multifamily space. Walk us through what you guys are doing with other asset classes right now in this moment.
So multifamily is an amazing asset class. We have such a high level respect for multifamily that we are typically on the co-GP side. So if we step in, it's because we've raised a lot of money and we're working with a friend that we dearly trust that's a best in class operator. We are never the operators on multifamily deals because it's so incredibly competitive on the operations side that we have respect for people that we're happy to partner with that are best in class. Yeah. For our bread and butter on the syndication side, we are absolutely unquestionably best in class in industrial. So we operate in the top most competitive markets. Our average return on our syndications for our last 7 exits is 35.5% IRR on the industrial side. And we are extremely competitive when we enter a space. And we're looking at that probably tail end of 2024, entering the industrial side. It's a different market cycle than most of commercial. So timing's a little bit different for industrial because you're dealing with single tenant, gigantic, very expensive assets. So the timing of where you start meeting space with multinational tenants is a different time of the market cycle. But on the multifamily side, we work with fantastic operators, a handful that we have dear relationships with. And on the industrial side, we're absolute killers. But we time things well to make sure we get good returns.
There you go. I love it. I love it. Yeah, definitely, super important when it comes to partnerships, when it comes to the current market environment. We have a fun election coming up. We're not going to dive into politics. However, where do you see the current market going? I know you may not have a crystal ball. If you do, please share it. But if you don't, would love to hear your opinion on where you think the market's going to go overall in the multifamily sector and in the real estate sector.
So I'll give you what I'm seeing in the market, especially on the economic side. The election throws a lot of things for a loop. One, we've seen historically, consistently, the sitting president leans on the Federal Reserve chair. That's very consistent, right? So in this case, Joey Biden is putting his hand on Jerome Powell's shoulder and saying, Jerome, drop the damn rates and boost this economy. I want to go in with the strongest foot forward to the election. Okay. So that's one thing we know. Now, if we just set the politics aside of that, let's look what the Federal Reserve is signaling to us. The first is they've hinted, sometimes clearly, sometimes a little less clearly, that they don't have an interest in raising rates. Okay. But you can have a crystal ball of what they're doing from the dot plot. Have you ever checked out the Federal Reserve dot plot charting?
Yep. Well, I see that.
Okay, so that in the next 12 months, so let's just say 2024, there's the positions on the Federal Reserve have placed a dot on a map saying where they think rates will go. Correct. In the next 12 months, they expect rates to drop around 100 basis points.
Yep.
So 2024, a reduction of 100 basis points, which is 1%. 2025, they're saying the same thing. That seems like a longer bet where there's less confidence in that. They're saying an additional % drop. So that's what they're signaling. If you were to ask me my bet, I think inflation's a little stickier than they're giving credit to. I think that they will drop or pursue rate decreases this year with the election year. But I see rates stabilizing around the 5 to 6 mark for an extended period of time. That's what I would tell you for the next handful of years, with the balance of fighting a little bit of inflation versus trying to appease the market, but not staying too high because, by the way, we have 33 trillion in debt, 34, I think.
Yep. Nope. You're spot on there. I definitely see it the same vision as you. I love that. Opinion and that outcome on it, but I'm in agreement with you on that one. Well, let's wrap things up with our path to success on our 4 questions. Are you ready for it?
I'm ready, man. I'm excited.
All right. Let's do one book you'd like to recommend.
I'm just finishing up a book called Man's Search for Meaning. I read it every few years. It is, the first half is about a man's experience with a concentration camp, a Jew's experience in Auschwitz, actually. It's a devastatingly grim book on the first half. And the second half is the most beautiful take on why we're here on this planet and how to make the most out of your life. So it's a very emotional book. It's very difficult, but anytime there's a lot of crazy things going on in the world, or I need a perspective shift, I return to this book and it really kind of centers me in my heart on the most important things. So I really can't recommend that book enough.
Love it. Love it. A situation you overcame with having a strong mindset and it turned out to be a great business decision.
Oof. Yeah. So I have an entrepreneurial streak. I'm kind of built and sold multiple companies in the past. There was kind of a perfect storm that occurred in my life where we were having issues with a few companies. They were making, at their peak, they were doing 7 figures a month and 55% margins. So very high margin, great businesses. but I was working 100-hour weeks. And what I realized during that period of time was I had lost relationships with my friends. I had lost relationships with my family. I was making a ridiculous amount of money, but I was basically killing myself. My health was failing. I had a huge health scare. And the woman that I thought I was going to marry, somebody that I cared about deeply at that time, that relationship was on the rocks. So really, my whole life turned upside down in a moment, and a really, really tough time, even though I was making a lot of money. And I readjusted what I wanted and what I wanted to focus on. And I realized that I was making about 90% of my income from real estate, despite all the money that I was making on other things, because I had been shoveling money towards real estate investments. And I was like, man, it really is very obvious, the juice versus squeeze reward of real estate. Let's scale that up instead of doing all this other stuff. So real estate was a shining star for me in that moment. And it really was it's really my passion today for that reason. Of the lowest point, it was the best thing in my life. And we leaned all the way into it. And I'm very happy now with that decision.
Love it. Love it. Best business decision / deal you've accomplished.
I'll give you the highest return that I've had on a deal, because of the fact that there's a lot of pieces there. We had a deal that was in a bad market, a difficult situation with bad zoning. So basically 0 out of 10. If you look at the deal at a face value at that time, we saw a huge opportunity. Some zoning changes were happening. Some new things were going into a city. And we basically negotiated and worked on a zoning change for about 2 years, 2.5 years with the city. And that is the most, so finding a low value zone that you can change to a very highest and best use zone, we have done over and over and over again on multiple deals to have ridiculous returns. I still love that strategy, and that's made us a lot of money along the way. And one deal, our shining star, took everything from meeting with the entire Chamber of Commerce and City Council, et cetera, to pull it off. But it's been a fantastic deal for us and our investors since then, using that strategy.
Love that. Love that. Let's talk about one way you like to give back to the world.
Yeah. So for me, it is, so I have the DeAngelo Foundation, and that's my way of putting money in a charity that we control the majority of where that money goes. And our biggest causes are, cancer is very close to my heart. I just think it's a very brutal thing that is such a difficult thing for so many families in the country. And then the other side is entrepreneurial education. Really, I see small business as the backbone of our country. If you look at the percentage of jobs, I think it's north of 80%. If you look at the majority of, the support for middle and upper classes, it's so important to have entrepreneurial skill sets. So between those two things, I want to put as much money as I possibly can afford to go towards those and see how we can make the world better.
I love it. I love it. Nick, how can people get a hold of you if they're looking to invest alongside of you, gain some more knowledge?
Yeah, we put out fantastic, free, detailed, strategic webinars for people that want to learn about economics, learn about real estate, learn how to invest. Those can be found at saintinvestment.com/resources. It's all free, and it's literally us just giving you as much as we possibly can for free. And there's a bunch of resources there where people can invest and learn more about the investments too.